So we had the Nasdaq defend mid vamp this week or today. We're recording this on Wednesday. So that's a pretty good sign. I was actually getting kind of concerned a little bit at the open today, just because it was a very slow down esque kind of day. Like we saw utilities ripping, healthcare ripping, bonds ripping, and the Nasdaq dropping. And so I was kind of worried maybe we are kind of entering more of a slowdown. Obviously, it's just one day, but if it becomes a trend, then it could be a cause for concern. But we did end up closing fairly decently. The Nasdaq got rejected once it dipped below mid vamp, so that's a very good sign.
Yeah. So like, what a defense here, man. I really thought midday when we saw this print, I was like, okay, we might have lost mid vamp, and you know how it is. You lose mid vamp, you move to the next. You have the ability to move to the next zone. So like, for example, on last Friday, we lost mid vamp, and that opened the door or the possibility to go to lower vamp. We quickly recovered, basically rejecting this whole move and negating it and back above. And today again, defending mid vamp, and it's good. You want to defend mid vamp, and you know how this goes, right? Like as long as we're above mid vamp within the trend, for in this case bullish, the price action is going to be higher. Like our base case is higher. If we're in a bullish trend above mid vamp, the base case is higher. So that's our outlook on the Nasdaq there. But you brought up bonds, and I think that's a good point. I mean, bonds had a nice gap up today.
Yeah, they're
They
getting pretty
had,
close to Momo.
yeah, TLT has been moving up this entire week. I mean, definitely a bond outperforming week. Call it, I know you said it was a slowdown esque type of day, but I'd even go one step further and say it was more of a slowdownish week. Now, we'll get into the minutia there in a second, but long story short, bonds popped this week. They're doing okay. I think that I was tweeting about this a while for a couple of times, or I don't want to say that. I was tweeting about this quite often the last couple of weeks here, where I think that we're in a position right now where the dollar's rallied so hard. I mean, we could just look at the dollar, right? So let's take a look at the dollar. Dollar's rallied so hard off the lows. So like we were at 100, we rallied nearly 7% in the dollar in like a month. Okay. And bonds themselves got smacked. And I think you're in a position where the dollar can pull back, rates can kind of reverse, kind of rebalance, right? And that's going to be risk positive up until a certain point. I think obviously in the scenario where bonds go bullish trend, right? And they break up and they start moving higher, I think we should be on the lookout for possible acceleration and slowdown fears. But as long as bonds are bearish trend and risk is positive, there's really not much for us to worry about.
Well, what do you foresee that's going to cause the dollar to drop further?
Well, I think that the interesting aspect with the dollar, right, is we have to look at the dollar for what it is. And I want to even take DDAP off here just to get a really simple view, make it line chart, right? So the dollar was at like 100 points going into October, and we went up to like almost 107.5, right? And there's a large correlation here to Trump winning the election because Trump is seen as a tariff guy, quote unquote. He even said, I am a tariff guy, right? And tariffs are generally currency positive, right? So they're currency bullish. So I think that this large move was really around Trump winning. And you could even see here let's go down to a candlestick right after the election, boom, just straight up, right? It's up into it, kind of pulls back into the election, after the election, rip. And I think that this has been an overall net headwind for risk assets. Now, I don't think you should look at the dollar and say like, okay, the dollar's up, risk assets need to go down. That's not how this works. The correlations are pretty fluid, meaning risk assets can rise with a rising dollar and they can rise with a falling dollar. I think that there has been a considerable amount of progress there on the risk side to stay as elevated as they have been with a rising dollar, even Bitcoin, right? Like Bitcoin, we're just under 100K, all on the back of a rising dollar and rising rates. And I think the junction here is you priced in this rapid tariff response from Trump, and we did get some tariff action this week or some tariff threats. But I do think there's a period where we are off sides now on the dollar, right? The dollar's a little too strong. Rates are a little too high, right? Like if we take a look at the 30-year, the rates went from under 4 on the long end up to 4.7 pretty much, right? And I think that this again is on the back of an overly hawkish Fed. So I think that let's take a look at the Fed funds forecaster, right? Or the implied curve. We were at only 2 weeks ago, we were at like 4 cuts for the next 12 months. And we came all the way down to 2.5. So obviously, we've just in the last 2 weeks alone, we've taken out a cut and a half in the market, right? And I think overall, the fact that we've gone mega hawkish to the point where the Fed isn't even expected to bring rates under 4%, materially, I should say, under 4% in the next 12 months is quite interesting. Um, and I think there's some things that we can kind of play match and, connect the dots with. Like, for example, let's take a look at the Citigroup Global Economic Surprise Indices, and you have the United States here. You can see that pretty much since September, we went from a negative 40 to pretty much negative 50 to positive 50. We did a complete reversion here. And I think this likely has peaked, and maybe we get some mean reversion back down to the zero line. And I think that would likely coincide with more dovishness showing up in the curve, meaning more implied rate cuts appearing again after they were just sucked away. And that would also coincide with higher bond prices, lower yields, and then therefore a lower dollar as well, right? Because one of the reasons the dollar's up, like we said, was Trump, but the other reason is as you hawked up the market, you basically sucked all those implied rate cuts out. You blew out currency differentials, because if you take a look here, like Europe is expected to get down to about 1.75 in the next 12 months. That's nearly half. That's over half of what the Fed is implied to get to. So as the Fed hawks up, or the market hawks up on the Fed, and basically doves out on the ECB, we're seeing more cuts in the next 1 year than we did 2 weeks ago versus the Fed less, right? So on and so forth. This is gonna basically make the dollar more attractive on a global scale, right? And money's gonna get sucked into the dollar. Therefore, the dollar is going to stay strong. So if you have a reversion in this short-term burst of economic strength, doesn't necessarily mean you're going into a slowdown or a recession. It just means a relief in that strong short-term momentum. I think you open up some dovishness in the curve, and you put some relief in the dollar, and you put some relief in bonds, right? So you push bonds up a little bit, and therefore it acts as a tailwind for assets, because you're basically adding some more easing onto the table. Now, it doesn't have to be a lot without necessarily having a recession.
Well, it depends why that easing is getting priced in, though, right? If we start seeing bad data coming out, which justifies easing, that might not be good for equities.
Oh, absolutely. It really comes down to, what's going on, like where the neutral rate is. And we should kind of talk about what's implied here in the next presidency, right? Everyone's so sensitive to the idea of Trump's tariffs generating inflation, right? So we should take a look at the longer run median rate. So let's take a look at the longer run FOMC median rate. This is basically the longer run expected policy floor from the Fed. And, or I should say, I don't want to say policy floor, policy baseline, like where they expect the long run Fed funds rate to be. And for a simple breakdown of what's going on here, the best way to explain this isn't considered the neutral rate. More so, this is you can consider this the direction of which the neutral rate is moving. So when Trump gets into office in 2016, the long run rate's about 3%. His tariffs don't really start going into effect until 2018, right? Initially, we have this move up in the neutral rate, call it, or not the long run rate, excuse me, maybe 10 basis points or whatnot, and then it falls. Now, you would look at this and say, "Oh, that's COVID," and this decline here in the long run median rate is actually not COVID related. COVID doesn't show up until here, so you have to look at Trump's tariffs as a two-dimensional object. Yes, prices go up, but if the Fed isn't easing and basically easing conditions to the point where loan creation is accelerating and money supply is expanding, you're not going to get inflation. What's going to happen is pretty simple. You're going to have the cost of some goods go up, but the consumer doesn't have access to more money, right? Because the money creation is stagnant, right? Or it's not stagnant. It's not accelerating beyond a point that would generate inflation. I should say an acceleration in inflation, right? So cost of goods in one area go up, or maybe in a bunch of areas they go up. Consumer only has so much money, so they're gonna have to spend more money in other places than they normally would, and less money more money in one place and less money in another place. That's what's going to happen. It's not as if you're injecting a bunch of liquidity into the system and therefore giving the consumer money to spend money on everything, no matter what the price. And that's what we saw in COVID. That's why inflation went up so significantly. That, coupled with supply chain disruptions, made it a mess. I think what we're seeing here with Trump's tariffs are actually, believe it or not, more disinflationary / deflationary than anything.
Yeah. It also depends on what he does with growth. So
Oh
if
yeah,
growth is
absolutely,
able
yeah.
to match those higher prices that are induced by tariffs, it's not going to be as much of an issue. It's if growth really does tank, which that's the hard landing scenario, which is still in play, it's still possible, then that would not bode well for having tariffs. That would be even more disinflationary or even possibly deflationary.
So tariffs come on in 2018, right? And they're selective. These tariffs in 2018, they were more isolated.
What's the
Trump's
plan
talking.
with his tariffs now? Did he say are they going to be selective again?
No, I think he's looking for blanket tariffs at least on China.
Okay.
So and then, but there's some issues here that have yet to really come to fruition, which or I should there's some issues that could be resolved before he even implements, right? Because some of these are conditional. If country A doesn't do this, right? If these objectives that he's laying out for these countries to achieve aren't met, then these tariffs may come into place. So right now they're really a threat. But let's go back to 2018 where tariffs were getting put in. Now these were selective, of course, in 2018, so a little bit different. But if you look at 2018, right, you'll see that like inflation, Jan 2018, inflation gets a pop here, right? We get a pop up to about 3% on CPI. And then we get this really consistent disinflationary move, a pause, another little pop, and then COVID, right? So net disinflationary going into COVID. But what you'll see is growth is also slowing. So there's a possibility that Trump's tariffs, especially at a blanket level, will actually, believe it or not, bring inflation to target faster than you think. Because again, without you in 2018, you also had the Federal Reserve at in an easing mode, right? Like if we go back to 2018, remember the Fed started, or excuse me, 2019, right after the Fed starts easing. So they're pretty much restricting into 2019, and then right into 2019 they start easing. So where we are right now, the Fed has started easing, right? So we've seen the Fed gradually reduce interest rates. We're at 4, we're in the 4s now, right? But 4.5. But the Fed isn't necessarily easy on a policy stance, right? Inflation's at 2.6%. The Fed's at 4.5%. Now you could argue neutral, the base, the zero rate at which growth is not accelerating or decelerating and the economy isn't expanding or contracting has risen slightly. I think that rise that we saw might be offset quite a bit by Trump's new agenda. Now, there are some positive growth aspects of Trump. We'll have to see how they come to fruition. There's a lot of variables here, but I wouldn't be surprised, honestly, if Trump's policies alone bring inflation to target and actually make it a little harder for growth. But with that said, growth being obviously a possibility of or an area of weakness, I don't think necessarily it means again recession. It just might mean, instead of printing 3% or 2.7% GDP, real GDP, we might be printing 2. You know what I'm saying?
Yeah.
It doesn't necessarily mean like, oh, we're going to zero. Like that's not the case. The case is that there could be a growth hurdle here, and in turn, a disinflationary component of his policy that gets the Fed down to target and actually opens up the door for more easing. So it's a very interesting dynamic we have coming up here in the next year. We're excited to really see how this all plays out. It's a crazy time in America, right? But some other areas that have been getting a lot of Trump attention have been small caps, right? So let's take a look at the small caps. So IWM is pretty much at all-time highs right now. Small caps are seen as like the next area of where you want to take advantage of Trump being pro business and whatnot, a pro growth guy, stock market guy. The expectation is small caps should boom. Now, there's something very interesting I think we need to digest here is that I think that Trump is more so a pro business guy and likely will help small businesses, but I think we have to be very careful with small caps. I am just not a fan of small caps, and I'm going to show you why. So if we take the IWM against the QQQ, so basically this is a ratio of long IWM and short QQQ. Now, I know that some people are like, oh, look at this. We put a floor in. We're going up only. This is the bottom, generational low, whatever people want to say. Yes, it does look pretty interesting that we've been going sideways for a year here on the ratio. All in all, though, I want to zoom out. This ratio did well in the dot-com bubble because tech got absolutely obliterated to everything else. And then pretty much going into 2008, this ratio has never seen a real good run. We've seen pops that just get consistently faded. So I would be surprised if this time is magically different. Could it be? Yes, but I think ultimately what happens is like we saw last time when Trump won, small caps get a good push, lasts a couple of weeks, maybe a month, and then mega cap tech starts kicking back. And I think that's where we're going to end up here. I think there are some small cap winners that will be really just president cycle outperformers from when Trump gets in to when his term's up. But I think as a broad-based index, it's going to be very hard, in my opinion, to see small caps materially outperform big tech over the next 4 years, just based on what they've shown here history-wise, even with the tax cuts and whatnot. Large cap just dominates, right?
Yeah, I think there's even more variables involved with small caps because rates affect them a lot more than the Nasdaq. And so we have the variable of how much is the Fed going to cut? Are we really going to see a 4% floor or are we going to go lower? That stuff really matters for IWM, but not so much for the Nasdaq.
Correct. And I think that if I was a betting man on the small caps, this is what I would say. This is my bet. This is what I would say. I think that we got a couple weeks left of outperformance here in small caps, and this doesn't mean they go down, but I think if the market's going to go higher, you're going to see a rotation in large caps. And a good example of this is what we're seeing in the Nasdaq just even this week, right? So we started this podcast off with saying how well the Nasdaq has defended mid-vamp. It has done a really good job this week defending mid-vamp at all attempts to break lower. But what you really need to look at is dissect this one leg further. So let's look at the NASDAQ equal weight, meaning it's the NASDAQ without the concentration in the top 10 holdings. Basically, Mag 7 is not as influential, right? So if we take a look at the equal weight NASDAQ, you'll see that we're pretty much at all-time highs. I guess we didn't close the week at all-time highs, but from last week's, right? Last week we are now at all-time highs from the prior week. And we're just at highs in general. And if we take a look at the SPY, we're also at highs. And then if we take a look again at the Nasdaq, we're still off the highs made in mid-November. And then if we take a look at MAGS, which is basically the Magnificent Seven ETF, what you'll notice here is this is also off the highs since mid-November. So what this is telling me on a really simplistic view is, back to IWM at highs, the growth names are moving. Like the growth as a whole is showing positive signs. Risk on signs or signals are there. Growth indications are up, right? Just again, S&P near highs, IWM near highs, NASDAQ equal weight near highs. What we're seeing is a drag on the max. And that doesn't necessarily mean it's cooked for growth. That just tells me that, again, back to that IWM QQQ ratio, maybe what's been lacking here that's allowed the ratio to lift as it has, and maybe allows the ratio to lift some more, is kind of a pause or a lack of incorporation in returns, or I should say a lack of participation of the max. Now, if the mags decide to show up again, which they typically do at some point, I think this ratio gets pretty much smacked down, back down, and we start breaking lower again. And that's going to again require, mags to break out, turn around, and therefore QQQ will likely hit new all-time highs there as well. And in the process, markets up. I think that's where we are right now in the juncture of what's going on with equities. And based on what you're seeing here in the market, what do you think? What other signs of growth are you seeing that would give the basic listener the idea that maybe the Nasdaq not hitting all-time highs this week when all the other indices did are a strong indication that we're still in risk on?
Well, I think with the mags, we saw them move over the last few months and get extended. And so now we're just seeing this consolidation before the next leg higher. It's exhausted. There's been a ton of buyers. Everyone's been buying into Nvidia, Apple's hitting new highs as well. And so I think we're just seeing exhaustion right now. But when you look at risk on assets as a whole, you see Bitcoin completely reversed today. It's heading back to 100K. You're seeing ES, you're seeing the Russell. Everything is just hitting new highs. And the NASDAQ is no different. The NASDAQ is one of the best risk on assets you can buy. And when it lags like this, it typically tends to catch up shortly after. It doesn't lag for very long. And so I think we're just in that middle ground period where everything is still pointing towards risk on while there's
Yeah, I
still some
mean,
lags. Because at the end of the day, we're not in deep risk on territory. We just came out of the bond trade. The market is still slowly digesting coming out of the slowdown. We're still kind of in that in-between period. And when certain data comes out that points towards a slowdown, the market tries to run with it. And I think that's what we've been seeing in utilities and healthcare lately, which those are slowdown names. And we're seeing money drive into that as a hedge in case we do flip back into slowdown and risk off territory.
yeah, surprisingly enough, that's a good point there. But like you were saying, we're seeing Bitcoin make that sharp reversal today. We're also seeing the XLY, the Consumer Discretionary Index, close at all-time highs. Literally close at all-time highs this week, and that's like the Amazons, right? The Home Depots and whatnot. So this is not bearish. Quite frankly, this is the complete opposite, right? When you have consumer discretionary leisure spending at highs, this is not bearish. Now, back to what you were saying, I think that we're at this zone where we could perhaps see some flirting with a slowdown. That doesn't necessarily mean it's going to come right away. Models will guide in that case, right? They're going to take it day by day, regime by regime. but there is a possibility something like that does happen. And I think, like, to your point, yeah, XLU's seeing a nice bid, right? XLU's new all-time highs as well. And I think that this is on the back of the fact that we are in a precipice here where, as I was saying earlier in the podcast, the dollar is going to have a zone here, call it a window of weakness, the ability to weaken, right? And with that, rates are going to be able to weaken too, which will obviously push up bond prices, and that is actually going to be slow down positive, because what it's going to do is it's going to create more of an attractive situation where you're going to, like, utilities become more attractive, healthcare becomes more attractive, as the market tries to decipher, are we just getting a period of expansionary rate and currency movements where the dollar weakens a little bit, rates fall a little bit, but it's not fearful. It's more of easing, right? It's more of an easy fall, not a fearful fall. And in those periods, the defensives always like to catch a bid, which is why XLU's catching the bid, XLV's catching the bid, even X real estate's catching the bid. It's all for these reasons. So I think there'll come a point, just like with the IWM and QQQ ratio, which we were just speaking about, like, rolling back over. I think there'll come a point where the market really picks up on the defining zone that, is going to keep us out of that slowdown territory and really in risk on. And that's where you're going to see that rotation with the Qs, where people come in and power bid the mags. They send the mags to new highs, they send the Qs to new highs. And then you'll even see something like, look at the QQQ to SPY, right? So long QQQ, short SPY. This has been going sideways for months, meaning, like, if you were long Qs and short SPY, which tends to do well in risk on, this has gone nowhere in quite some time. So it makes me think that if we're going to really venture back into risk on, we're going to see some type of move like this, where we pivoted out of risk on mid-July or early July. Like, right around here is when we pivoted out of risk on. So it wouldn't surprise me if risk on holds and firms up, that we could see this ratio re-expand and blow back up to new highs. But that's all for this week's podcast. If you guys are interested, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com to get access to our daily models, our macro regime models, and our DDAP trading view script. Thanks again for watching, and have a wonderful Thanksgiving.